Hello, welcome to LifeWatch. Today I want to go over an investment strategy I'm doing. Like I said, this is my investment strategy. I am not a financial advisor, so please do your own research before you start investing your money. All right, well, let's get started. As you see here, I have everything broke down, and to the left is the percentage you would put into individual stocks, and then to the right is what you would put into different mutual funds, index funds, or ETFs. And then I have the percentage changing as you get older with age. It is very difficult to pick individual stocks and to exceed the overall market. It is, however, possible, but you are going to have to do your research. If you are not willing to do the research, this is not the appropriate strategy for you. All right, I will say this again. If you're not willing to do the research, this is not the appropriate strategy for you. It takes a lot of time and effort to go into doing your research on a company before you want to go in and put quite a bit of money. But if you're willing to do the work, learn how to do the work, you can really start seeing, I've seen several people get 100% gains on a stock when they buy it. Like if you had bought Tesla back a year and a half ago, you would get 8 times your money now, 800% return, which is crazy good. Okay, so let's get started here. So you're going to pick individual stocks. Now you're not always going to get a 100% return or an 800% return, but you can definitely get more than the market average of 10%. All right, so it's nothing to be able to get 20 up to 30% on some of these stocks if you buy them in dips and sell them in the peaks or whatever. So let's start out. At your top line here, we have ages. You get 18 to 25, 26 to 35, 36 to 45, 46 to 55, and 65 to infinity. All right, so we'll start out here on the 18 to 25 age. Here I have you put 80% of your investments. It should be going towards the individual stocks using this method, and 20% will go into mutual funds. It's a very conservative number as far as it's a very risky percentage, but you're at such a young age that it should still pay off long term for you. All right, as long as you don't invest in companies that are going to go bankrupt. I personally don't necessarily recommend investing into startups very early on when they go public. Wait for them to be public for a while, see how the market reacts, and then once the time is right, buy into it. Such as Facebook, when it went, I think when it went public, it was around $46 a share, something like that. And I think it went down to like $20, $18 a share. That would have been the perfect time to buy. Of course, even if you had bought whenever it did go public, it's now $200 some a share. So you still would have made good money. But that's just an example of, usually they start a little high, then they drop off for a little bit. Maybe that's the time you want to buy. All right. So another thing I forgot to mention is you need to at least be investing 25% of your money. If you cannot invest 25% of your money, you need to be paying down debts or whatever else you got to do in order to be able to free up some money to put 25% down, or 25% of your income into investing and savings. Okay. Well, that's for how to get there as a topic for another video. All right, so 18 to 25, we're going to do 80 into individual stocks and 20% into mutual funds. Moving on, we go in the 26 to 35 age range, 65% into individual stocks and 35% goes into mutual funds. Move on a little over. This is a 36 to 45. This is where you really kind of start slowing down. You do 50-50, okay? So you have 50, it's going to percent in mutual funds, which is going to be a very conservative, reliable number, and then the individual stocks, 50%. So you still get quite a bit of good growth off of that, but it's definitely going to slow down the amount of growth you're getting. But at this point, you should already have a pretty big portfolio, especially if you're investing 25% or more of your income. The 46 to 65, this is where we're gearing up for retirement. So 25% into your individual stocks, 75% into mutual funds. And then we go on to the 65 and beyond, 10% or less I would recommend into your individual stocks and 90% into mutual funds, index funds, and that sort of thing. This is where you are, your retiring age. Surely, hopefully at 65, you're retired and you're starting to live off of these investments. So you need to be very conservative. so that if the market shifts a lot, you don't move down a lot in money. It's nothing worse than being retired for 10 years, and then you got to find yourself back at 75, back in looking for a job in the workforce, which would be pretty difficult for you. You're already 10 years out. Times change pretty quickly with all new technologies, and you don't want to find yourself struggling to find a job or somewhere that you can be useful out in the workforce. All right, so we'll zoom back out here. Again, this is an investment strategy, my investment strategy, not a financial advisor. This is just what I'm personally trying to work towards. At least 25% of your income or more. I've seen people do up to 50%. That would be great. That's how you're really going to start making some big moves in this, and maybe even be able to retire early. But here you can see all the percentages. 18 to 25, you're 20% individual, 20 into mutual, and then 26 to 35, 65, 35, ages 36 to 45, 50-50, ages 46 to 75, start slowing down here, 25 in individual, 75 into mutual funds, and then retirement age, 65 and beyond, I would recommend 10% or less into your individual stocks and 90% into mutual funds. All right. Thank you for your time watching the video. Please like and subscribe.